We often think that successful investing is all about picking winners, right? Finding that one stock that's going to take off. But what if I told you the real secret isn't about picking winners at all? What if it's about understanding and, well, mastering the powerful, unseen forces that are always shaping the market? Because believe me, beyond the headlines, there's some deep currents at play.
Yeah, we hear about bull and bear markets all the time, but the things that truly drive risk and reward, they're often hiding in plain sight. We're talking about forces like the unstoppable march of time, the sheer speed of price changes, and that electric current of market volatility. These are the forces that can really make or break a portfolio.
So, how in the world do you navigate all that without getting completely swept away? Well, the first layer of defense is actually the simplest, but it's also the most crucial. It's all about setting up some basic, fundamental rules for survival. Think of it as a trader's first line of defense against the market's toughest lessons.
Now, I know what you're thinking. Sun Tzu, the ancient military strategist, what does he have to do with trading? Well, it turns out his wisdom is absolutely timeless. This quote just nails the essence of risk management. Winning in the market, just like winning a battle, it happens because of careful planning and strategy before you even place a trade. It's not about just reacting in the heat of the moment. And this is where that planning becomes absolutely essential. Your battle plan needs two things that are totally non-negotiable. First up, your stop loss. That's your line in the sand. It's what protects your capital when a trade goes south. Second, your take profit. That's your goal, how you lock in your gains. By setting these points in advance, you take emotion right out of the equation and just let your strategy do the heavy lifting. And here it is. This might just be the single most important rule for survival out there, the 1% rule. It's so simple, but it is profoundly effective. If you never risk more than 1% of your total capital on any single idea, you guarantee that no one bad trade can ever wipe you out. This simple rule lets you stay in the game long enough for your good ideas to actually work. All right, so with our basic defenses in place, we can start to get a bit more sophisticated. This is where we enter the world of options, which, let me tell you, come with their own very unique set of risks. To manage them, traders use these metrics called the option Greeks. The best way to think of them, they're like the instrument panel in a cockpit, giving you real-time data on your portfolio. So on this dashboard, you've got four main gauges: delta, gamma, theta, and vega. And as you can see, each one is tracking a different invisible force that's acting on your position. We're talking about everything from the stock's price to how fast that price is changing to the constant decay of time and even the mood of the entire market. So let's break down what each of these gauges is really telling us. First up is delta. This is your most straightforward gauge. It tells you exactly how much your options price is expected to move for every $1 change in the underlying stock. It's basically your direct measure of how much skin you have in the game, directionally speaking. So for example, a delta of 0.50 is super easy to get your head around. If the stock price goes up by $1, your options value goes up by about 50 cents. Stock drops $1, you lose about 50 cents. Simple, right? It gives you a really clear sense of your potential leverage. Okay, next we've got gamma. Now, if delta is your speed, think of gamma as your acceleration. It's the gas pedal. It measures how fast your delta itself is changing as the stock moves. High gamma? That means when a stock moves in your favor, your profits can accelerate like crazy. But, and this is a big but, it's a double-edged sword. Your losses can accelerate just as fast if that trade moves against you. Then there's theta, which represents one of the most fundamental, kind of harsh truths about options. It's often called the melting ice cube, and for good reason. Theta measures that constant, unavoidable erosion of an option's value just because time is passing. Every single day that goes by, your option loses a tiny bit of its worth, and that decay gets faster and faster as you get closer to expiration. And finally, we have vega. Now this one is fascinating because it doesn't measure risk from the stock's price or from time. Nope, it measures risk from the market's mood. Vega tells you how much your options price will change when the market's expectation of future volatility, its fear level, basically, goes up or down. It's a direct gauge of the fear and greed in the air. And that idea, it brings us to the next level of thinking. Once you really get Vega, you realize something powerful. You don't have to just react to volatility. You can actually measure it, you can analyze it, and you can even learn to trade the storm itself. So what exactly is volatility? Well, on the surface, it's just a measure of how fast and how far prices are moving. But for a really savvy investor, it's not just some risk you have to be afraid of. It's a quantifiable force. High volatility means big swings and a ton of uncertainty. Low volatility suggests things are calm and stable. And believe it or not, traders can build entire strategies around capitalizing on these changing conditions.
Which brings us to our third and final layer, the institutional level. How do the biggest players on the street, we're talking massive banks, huge hedge funds, how do they manage risk when there are billions of dollars on the line? Well, they run what's known as the institutional gauntlet.
Their ultimate tool is the stress test. See, they don't just plan for normal, everyday market swings. They actively simulate disasters. They take their entire portfolio and throw it into these extreme, hypothetical nightmare scenarios: a market crash, a currency collapse, a sudden rate shock, all to find the breaking points before a real crisis ever hits. But how bad can things get when those standard models fail? Just take a look at this real-world example from back in 1997. A securities firm had a risk model called Value at Risk, or VAR, that predicted a maximum one-day loss of $16 million. Well, when a major crisis actually hit, the real loss was $184 million. That's more than 10 times what their model said was even possible. This is exactly why stress testing for the truly unthinkable is so critical.
And this whole challenge of modeling for extreme risk, it's even more intense in today's new financial frontiers, especially crypto. And the reason is that the risk isn't just about prices swinging around. It's about the very plumbing of the market itself, how assets are actually bought and sold, which is called liquidity. And in crypto, that plumbing is built on totally different principles.
You see, in the crypto world, you basically have these two parallel universes for trading. You've got your centralized exchanges, or CEXs, which work a lot like traditional stock markets with professional market makers. But then you have decentralized exchanges, or DEXs, which use something completely different: automated pools of capital where algorithms set the prices. The split market creates all sorts of unique risks that institutions have to figure out how to handle. And yet, even with all these new complexities, the institutions are jumping in. I mean, look at this number: $191 billion. That's the amount of assets currently under management in crypto ETFs. It's a huge signal that the big money is actively engaging with this new world and figuring out new ways to manage its unique risks.
So, okay, we've gone from simple trading rules all the way to the complex world of institutional finance. What's the big takeaway here? The smart investor's edge isn't about finding one secret tool. It's about being able to synthesize and understand all these different layers of risk.
This pyramid really shows the path to mastering it all. You have to start with that solid foundation of simple, unbreakable rules. From there, you learn to read the hidden forces using tools like the Greeks. Then you learn to measure the market's mood by analyzing volatility, and you prepare for the worst-case scenarios with stress testing. And finally, you learn to adapt all those principles to brand new frontiers like crypto. See how each layer builds on the last?
So in the end, risk isn't just some number on a screen, and it's not just a feeling in your gut. It's a combination of these deep, powerful forces that, it turns out, can be understood, they can be measured, and they can be managed. And once you've seen behind the curtain at how these forces really work, well, the real question is, will you ever look at the market or at risk itself the same way again?